on Business Incorporated today. Movement restored at the Suez Canal after vessel failure. Ethiopian Airline asks for 15 years tax moratorium from Nigeria. And Chinese foreign minister tours 5 African countries. Good afternoon. Welcome to Business Incorporated this beautiful Monday afternoon here on Channels Television. I'm Ini John Mekwa. Let's start off straight up with market numbers and see what's happening. We start off with Nigeria. It's a positive one for the NGX at intraday, more than 1% in the positive at 51,836.15. In Egypt, it's also positive 1.42. There we see that's for South Africa, almost 2%. As you see, at more than 78,000. And then we look at other parts of the continent. In Egypt, also in the positive sentiment, mostly in Africa now. But Kenya closed Friday in the negative 0.37. By tomorrow, we'll know how it closed for today. We move from there to the Middle East and see that Abu Dhabi is in the negative. It's mostly negative there, 0.27 for Abu Dhabi at 10,170. Dubai in the positive, looks like the only positive for that region, 0.59 at 3,321.99. Looking at some other countries right there, we see Saudi Arabia 0.76 in the positive, and Qatar also in that region. And then we go to Asia. For Asia, we see Kospi is in the positive, 2.63%. Nasdaq also in the positive at more than 701, 1.78. That's positive. Hang Seng also in the positive at 1.77. Shanghai Composite still following that trend. And then Shenzhen also positive at the close of trade. And Australia also following in that positive sentiment at the close of trade. So let's go to Berlin now and see what's happening in Europe. It turns out that almost a third of passengers saw their flights delayed or cancelled last minute. That was last year, 2022. Well, that's worse than before the pandemic. Meanwhile, it would appear that Germany's airports are recovering slower than other European countries. But let's get the real picture of what's going on in Germany, and especially looking at the aviation sector. We have Rob Watts now joining us. Hi, Rob. Good afternoon. Well, we have new data giving an overview of the aviation sector in 2022. Looks like it was a really tough year for European airports and air travelers.
To take a flight, it was more miserable than they were used to before the coronavirus pandemic hit. 250 million passengers saw their flight either delayed or cancelled at the last minute during 2022. That's according to passenger pressure group Air Help. That equates to a 1 in 3 chance of getting a 15-minute or more delay to your flight, or your flight not taking off at all, and is worse than the 1 in 4 chance pre-pandemic. There's a fairly simple explanation for why that was the case, and it was this clash between the return of demand for flights post-pandemic and the underpreparedness of airports and airlines to cope with it. Many of them drastically reduced their staffing at the height of the pandemic and suddenly found themselves having to rapidly rehire people, and they just couldn't keep up, and that meant all kinds of problems at security gates, in baggage reclaim, and elsewhere. Throw in also industrial action at many airports during the course of 2022, with wages failing to keep up with inflation that's very high here in Europe, and ultimately it was passengers who suffered. And things are barely getting better, it would appear, according to Air Help. It predicts similar levels of under-reliability in 2023.
All right, so you mentioned recovery there. How's that going generally, and then looking at Germany?
Well, as I said, there was this huge bounce back in people taking flights last year, to the point where some countries are now seeing 94% of the air travel that they had before the pandemic. However, the recovery in Europe is moving at a different pace in different countries. Germany, for example, well, here is performing worse than many of its European neighbours. It's only offering 78% of the flight capacity that it was back in 2019. That's according to the German Aviation Association. Why is Germany doing worse? Well, it's largely down to a slow recovery of domestic air travel in particular. It's only a little over half of what it was pre-pandemic, and that's because low-cost airlines seem to be reluctant to reinstate all of their flights within Germany, preferring to increase their offerings elsewhere in Europe. The precise reason for that isn't terribly clear, but the CEO of Europe's biggest low-cost carrier, Ryanair, has previously complained that German airports are charging high fees and therefore making operating elsewhere a more attractive prospect. So we'll see how that plays out as we move through this year.
All right, Rob. So I wonder how the stocks are faring, the airlines and other stocks in the market at this time.
Well, the reopening of China's borders is the most significant development for markets today. After 3 years of closure, travellers from China are once again heading out into the world again, taking their spending money with them. Tempering that is the fact that a lot of EU countries have imposed a test requirement on Chinese arrivals, but it is expected to boost markets nevertheless, as are jobs data out of the US from Friday that appear to make another aggressive Federal Reserve interest rates rise seem less likely than before those figures came out. On the downside, though, 40% of German companies are expecting to see their output decline this year, according to survey results published this morning, and more industrial data from Europe's biggest economy is due out during the course of Monday, along with European unemployment figures, and those are all expected to shift investor sentiment here in Europe during Monday trading.
All right, Rob, thank you so much for that update. We'll certainly do this again tomorrow. All right, and now we move over to the UK, where Juliana is standing by, of course, to bring us up to date. Juliana, good afternoon. I did see that conversation you had with Laddie in the morning, but now it sounds like we're having a little bit of hope, I hope. You know, we see that the government is talking to the unions now. Perhaps this will solve this strike problem we've been having since last year.
Good afternoon, Innie. Let's cling on to that phrase that you just mentioned, hope, because we're going to need a lot of it for the rest of the year. Going back to the conversation, as you referenced, with Laddie this morning, we were discussing new data and research released by the Resolution Foundation think tank, suggesting that, you know, we've got so much more in store for this cost of living crisis and that the worst is yet to come. Pivoting away from that, one of the biggest, most pressing talking points this week for sitting House of Commons members, because they are back after a 2-week recess, is whether or not the British government are willing to finally negotiate with striking workers. And there was a glimmer of hope of that, because we did hear yesterday from Rishi Sunak, who slightly loosened his tone, shall we say. A lot of people complaining that the Prime Minister was completely stoic during last week's New Year address when he failed to mention the big elephant in the room, which was industrial action. Now, there have been a series of government meetings late this morning. We know that Gillian Keegan, who is the Education Secretary, she has been speaking with teachers who are pretty much not happy. They're willing to strike any day soon. And also Steve Barclay, the Health Secretary, has been speaking with union bosses from the NHS. And now this is massive because, of course, the fact that we had 2 strikes late last year from NHS workers was, you know, the biggest industrial action we had seen from that sector in history. Now, this is still developing news, but from what I heard just before I came into the studio, it does appear that unfortunately those talks have failed it did appear to be pretty tense. We did hear from the chief exec of the Royal College of Nursing, who represents the bulk of these striking nurses, and I do believe that she said in a statement that no offer was made, which is pretty terrible. And I think now it's just going to see who is going to flinch first. We know that striking nurses, they want a pay rise higher than inflation. Inflation currently at about 10%. They were suggesting 19%, too high, Rishi Sunak says, because that is going to increase inflation, but perhaps he could go down, although we have heard that perhaps talks with Stephen Barclay, the health secretary, didn't go too well. So there are going to be more strikes this week. Unfortunately, for our viewers watching in the UK, we're expecting bus strikes, further rail strikes on Thursday, and driving instructors as well. They're also not happy with how much they're taking home at the end of the month. They'll also be striking. So far, not so good, unfortunately, Inni, although we are still holding on to that hope phrase you mentioned earlier.
Yeah, Juliana, a lot of strikes going on. I was really hopeful and thinking that that's, something positive will come out of that, and then we don't have to resort to, remember the employers' anti-strike law we discussed last week. I do hope that we don't get to that, Juliana. But let's look at the market now, how the market numbers doing.
Quite interesting, actually. There's been a rapid fall on the blue chip index. It started off the first full week of 2023 in a high, in fact, a 4.5-year high, boosted, as we were discussing in Germany, by the reopening of China and the fact that a barrel of Brent crude is high, so the oil titans BP and Shell were leading the risers. But it's since slipped back into the red. We are expecting an update from the Chancellor, Jeremy Hunt, on energy support package for business beyond March. This has been a huge topic of discussion during the Christmas holiday. Lots of businesses not able to invest, not able to plan, because they don't know if they're going to be able to keep the electricity and the gas on after March. So I think that's rattled investors a little bit. The all share is down 0.12%. FTSE 100 down by 0.12%. In the FTSE 250, the domestic market, that's down by 0.62% at intraday. In the currencies market, the British pound is currently trading up against the US dollar by 0.35%, also trading up against the euro by 0.03%, and up against the Japanese yen at intraday by 0.24%, Inni.
All right, Juliana, thank you so much for giving us that update. We'll hope one miracle happens about the strike and we have a little bit of good news tomorrow.
Yeah, thank you.
All right, then let's see what's happening. Juliana mentioned oil there. Oil prices climbed more than 3% on Monday as China's move to reopen its borders boosted demand outlook and overshadowed global recession concerns. The rally was part of a wider recovery in risk sentiment supported by both the opening of the world's biggest crude importer and hopes for less aggressive increases to U.S. interest rates based on recent U.S. data, with Asian equities rising and the dollar weakening. Brent crude was up by $2.51 to $81.01 a barrel, while U.S. West Texas Intermediate crude rose by $2.55 to $76.32 a barrel. The rally followed a drop last week of more than 8% for both oil benchmarks, and their biggest weekly declines as at the year or since 2016. As part of a new phase in the fight against COVID-19, China opened its borders over the weekend for the first time in 3 years. Domestically, about 2 billion trips are expected during the Lunar New Year season, nearly double last year's and 70% of 2019. In the metals market now, gold prices hit an 8-month high today as the dollar slipped on bets for slower U.S. interest rate hikes, while investors also cheered a top bullion consumer, China, for reopening its borders. Spot gold rose 0.4% to $1,873.72 per ounce. That's the highest since May 2022. U.S. gold futures gained 0.4% to $1,877.40. The weaker dollar is likely the main factor lifting gold, and investors have also started slowly increasing their holdings in exchange-traded funds, indicating positive sentiment in gold, making gold one of the most sought-after metals at this time. Elevated rates dampen interest in non-yielding gold, as they did for majority in 2020. Let's take a break now on Business Incorporated. When we come back, we'll stay on the African continent. To stay with us. You're welcome back. Still watching Business Incorporated here on Channels Television. Let's head over to Kenya now. Kenya had some good news last week. Kenya's inflation dipped to 9.1% year on year in December, down from 9.5% a month earlier. Inflation peaked at 9.6% in October, which was the highest in the country since May 2017. Meanwhile, Kenya's shilling has weakened now to a fresh record low today, and that's because of increased demand for dollars from general goods importers, and is expected to lose further ground during the week due to pressure from oil retaining companies. Commercial banks quoted the shilling at 123.60 for $80. That was this morning. Sounds like a mixed bag, but let's get the reality on ground from Dominic Omondi. He's a senior business reporter with the Standard Group, joining us from Nairobi. Hi, Dominic. Good afternoon. Well, is this good or bad? Back here, we were challenged by the fact that your inflation dipped, and now we see your shilling is weakened. What's really going on? How is the economy at this time? Dominic, I think you're muted, Dominic. I think you should unmute. I cannot hear you. Yeah, good.
Can you hear me?
Yes, I can hear you now.
Yes, as you just put it, it's a mixed bag actually. So we have some of the indicators that are going green, some are going red. As you put it correctly, inflation has been going down. One, the weather has been favorable. As you know, Kenya's economy is largely driven by that. So when the weather it tends to increase supply of some of the basic harvests like maize, tea, coffee, and all that. So because we've had good weather, so prices of vegetables mostly are going down, and that has brought down inflation. 6 in October, 9.1% in December. But also, of course, the decision by the central bank to tighten has also contributed to the inflation. Tightening, of course, was done to deal with second-round effects of inflation. We've also seen globally some of the supply constraints starting to ease. Prices of major input products like palm also have been going, has had an effect in the country. Retail prices, it's like really shot up. So that is on one side, what you would say, the fortune that consumers have. They've also had to deal with an exchange rate that has not been doing very well. Shilling has kept on hitting record lows. That is because, of course, of increased demand of dollar. So we are currently dealing with what a lot of people have talked about, dollar shortage. So if you have, of course, at the end of this week, eventually our inflation is also being driven by the low exchange rate.
Yeah.
Then we are importing goods at a very high price compared to how we used to before. So that exchange rate basically drives up prices of consumers.
All right, Dominic Omondi, thank you so much, senior business reporter with the Standard Group. Thank you so much. I wish you the best in Kenya. Seems unfortunately that a lot of African countries have to deal with the issue of exchange rate and imported inflation. I guess it's time that Africans wake up and produce what they have to consume. That would be better for us. Well, moving on now, let's go to Egypt, where the Suez Canal Authority has said that a cargo ship carrying corn that went to ground early this morning in the Egyptian waterway was refloated and canal traffic has been restored. Admin Osama Rabel, head of the authority, said that the Marshall Islands flagged MV Glory suffered a technical failure and the canal deployed 4 tugboats to help refloat it. He said the vessel was being withdrawn to a nearby maritime park to fix the problem. Mr. Rabe said in a statement that the traffic in the canal resumed after the ship was refloated and 51 vessels were expected to pass through the waterway on Monday. The vessel ran aground about 5 a.m. local time and was refloated about 5 hours later. Senegal has lifted prices on subsidized fuel for a second time after last year's surge in oil to alleviate a squeeze on the government budget as of Saturday, the 7th of January. A litre of diesel cost 755 francs, that's about $1.23, up from 655 francs, while the price of unleaded fuel rose to 990 francs from 890 francs. Well, government expenditures on fuel subsidies in Senegal nearly quadrupled last year to 580 billion francs, according to initial estimates. The most recent price hikes should allow Senegal to limit that cost in 2023 to about 450 billion. Senegal's president unveiled a relief plan worth about 500 billion francs in November that includes rent subsidies and price caps on many basic goods to ease pressure on millions of households. Ethiopian Airlines has admitted that asking the federal government of Nigeria for 15 years tax moratorium, among other incentives, for it to partner on the board national carrier Project Nigeria Air. The airline argued that its request was a normal practice in international investment negotiations, insisting that it had not violated any known law in the country or elsewhere. The carrier argued that the federal government had agreed to sell 95% of the shares, retaining only 5%. The federal government had also invited 46% of Nigerian investors, while the other 49% was ceded to an international airline. And just before we go, Chinese foreign minister is in Africa. He's going to tour Ethiopia, Gabon, Angola, Benin, Egypt between today, the 7th, and the 16th of January, boosting trade ties between Africa and China. And that's where we draw the curtains on the program. Thank you so much for being a part of Business Incorporated. Another one comes your way tomorrow, 1:30. I'm Ini John Mekwa. Enjoy the rest of the day.